Have you ever wondered how some people make money when a company's stock price falls? It sounds strange, almost unfair, and for many people it feels like a business built on someone else's loss. That is exactly why short selling creates so much debate. Some call it smart strategy, while others call it profit from destruction. Short selling is a way of trading where an investor tries to earn money from a falling stock price. In a normal investment, you buy low and hope to sell high. In short selling, the process is reversed. First, a trader borrows shares from a broker, then those borrowed shares are sold in the market at the current price. After that, the trader waits and hopes the stock price will go down. If it falls, the trader buys the shares back at the lower price and returns them. The difference between the selling price and the lower buying price becomes the trader's profit. Let's understand this with a simple example. Imagine a stock is trading at $100. A short seller borrows one share and sells it immediately for $100. A few days later, the stock falls to $70. The trader buys that one share back for $70 and returns it. In this case, the trader keeps $30 as profit, not counting fees or other charges. But now imagine the opposite. Instead of falling, the stock rises to $130. Then the trader must buy it back at a higher price, losing $30. This is why short selling is considered very risky. The reason many people see short selling as controversial is psychological as well as financial. When a company grows, creates jobs, and increases value, people naturally feel that investors should benefit from that success. But when someone makes money from a company's falling stock, it can feel like they are celebrating failure. It may even seem like they want bad news, weak performance, layoffs, or panic in the market, because all of that can push the stock price down and help their trade. This is why short sellers are often accused of profiting from fear. In some extreme cases, they are blamed for spreading negative rumors, increasing panic, or attacking weak companies already in trouble. Whether that accusation is always true is another matter, but the image of short sellers as traders who win when others suffer has stayed strong for a long time. At the same time, supporters of short selling argue that it is not simply a dirty game. They say short sellers can actually help the market. How? By exposing fraud, overvaluation, and weak businesses. Sometimes a company looks successful from the outside, but its numbers are manipulated, its business model is broken, or its valuation is completely unrealistic. In such cases, short sellers study the company deeply, find the cracks, and bet against it. When they are right, they can reveal truths that others ignored. In that sense, short selling can act like a warning system. It can help prevent bubbles from growing too large. It can bring balance to the market by challenging overly optimistic investors. Without short sellers, markets might become more one-sided, where only positive stories are rewarded and negative realities are ignored. But even if short selling has a role in the financial system, the moral question remains. Is it right to earn money from decline? Is it ethical to benefit when a company loses value, investors panic, or employees fear for their future? This is where the topic becomes emotional, because the market is not just numbers on a screen. Behind every stock, there are workers, families, and real businesses. So when a stock crashes, it is not only traders who feel the impact. Another important thing to understand is that short selling has unlimited risk. When you buy a stock normally, the maximum you can lose is the money you invested, because a stock cannot go below zero. But in short selling, losses can keep rising if the stock keeps going up. There is no fixed upper limit to how high a stock can climb. That means a short seller can lose much more than the original amount involved in the trade. This danger became famous during events like short squeezes. A short squeeze happens when many traders short a stock, but instead of falling, the price suddenly rises. As the price climbs, short sellers rush to buy shares to stop their losses. That buying pushes the price even higher, creating a powerful upward spiral. In such moments, traders who were betting on collapse end up being destroyed by their own positions. So, short selling is not a guaranteed business of easy money. It may look clever from the outside, but inside it is a high-risk strategy that can turn against the trader very fast.
It requires deep research, strong discipline, and the ability to handle huge pressure. In the end, short selling sits in a gray area between logic and morality. Financially, it is a legal trading strategy used in many markets around the world. Morally, it often feels uncomfortable because it seems tied to failure, fear, and destruction. Some see it as necessary for healthy markets. Others see it as a cold way to profit from pain. That is what makes short selling so fascinating. It's not just a market strategy, it's a question about how money works, how markets behave, and how far people are willing to go to make profit. In a world where most investors chase success, short sellers do the opposite. They look for weakness, bet on decline, and try to win from the fall. And that is why short selling will always remain one of the most controversial businesses in the world of finance.